Isn't it nice to be in a business where there's not a stock ticker on our properties for the evaluation as the stock market is crumbling today?
I don't know. You tell me. I would always joke about how our apartment complexes don't have a big ticker symbol on the outside of them, constantly telling their price.
It's lovely, isn't it?
Well, it helps you sleep at night. It doesn't mean that private assets aren't as volatile because they absolutely do change in price just as public assets trade. It's just you don't see it, right? And investing is as much as a cerebral game as it is a psychological game. And if you can move things in your favor psychologically, it can really help, such as having the benefit of not actually seeing the price in your face every day. And actually, the fact that real estate, although it pays you an illiquidity premium, meaning you make more money because of the illiquid nature of the asset, you actually also can do better based on the illiquidity because it kind of keeps you away and less tempted to act on your psychology.
What are you snickering at? You're looking at and laughing at something.
Well, I'm just joking about the fact that there was nowhere for me to record because we've got 6 people in the corporate apartment this week. We're super busy doing a ton of asset management stuff down in Houston. So I'm outside on my balcony. And I thought, if I'm going to cook out here in the heat to record this podcast, I may as well smoke a cigar.
Yeah, that's very fair. Well, on that tune and note, what type of cigar are you smoking?
Well, Francis, of course, our very good friend Francis, he gifted me this Opus. And I've had it once before, but I haven't had it in a calm environment like this where I can actually sit and enjoy it. So I'm looking forward to actually tasting this Fuente Opus X.
Incredible.
I
Well,
would
if
never
you're looking to
personally, I
smoke,
would never splurge on such an expensive cigar for myself, right? I'm a cheap.
well, well, edify the fans, the listeners, the people here. What's the price point of a cigar like that?
So I think this is $40, right? Or is it more?
I listen. I literally have a strict buy policy on cigars that anything over $20, I don't have the palate to really appreciate it. Therefore, I won't do it. So I don't really look in that bracket. Maybe when I'm more refined, and if I'm get to be like Junaid, our friend Junaid in Houston, who is a connoisseur and ages them and knows the nuances there. Perhaps I'll be that guy at some point. One of more sophisticated, more wrinkles and more gray hair. But for the time being, that's exactly what I need. Give me a Connecticut, an Ashton, an Oliva, a Monte Cristo, and I'm good. However, I did leave you some gifts from my trip in Switzerland, which are several Cohibas and then a box of Monte Cristos, which will be broken into for our event. With that said, if you are a capital allocator, an investor, or an operator looking to kind of meet the best and brightest in the space, please check out our event, the Lone Star Capital Summit, coming up September 15th and 16th. It's right around the corner. Get your registration in as soon as possible to make sure there is still space because we're capping the number of people who are coming, and we're pretty close to that. Uh, Also, with that said, if you're looking to invest with us, learn more about our process and how to work with us, please let me know. Email me at craig@lsearea.com. I have Rob Beardsley here, live from Houston, as you just said. And one thing we want to get into today, actually, to start with, is the stock market. We're recording this earlier in the week before this is out, so things could change, obviously. So don't quote everything. But Rob, what do you make of everything going on? With that said, with the turbulence and pricing not looking very good, as we haven't seen a day like this in quite some time.
I feel very vindicated. I have been pounding the table. Maybe my timing isn't exactly perfect, but I don't think it was so wrong to say that being too early is indistinguishable from being wrong. But long story short, I've been regurgitating my readings to you and to anyone else who will listen about the fact that the labor market isn't as strong as people claim, particularly mainstream media, mainstream economic news. And now we're finally seeing the capitulation of the mainstream media and kind of the mainstream financial media capitulate and recognize the fact that, yes, the data is in fact materially weaker than we've let on. And all of the constant revisioning of data where the initial data comes out looking more positive and then it gets revised down. And that loop is now kind of finally caught red-handed. And I've been saying over the weekend that Friday, which was I think August 2nd, that was in my opinion, the demarcation of not necessarily the recession, but of people realizing that we're now in a recession. And then today, Monday, had a big sell-off on stocks. bond market opened, rates opened way down, and then they've kind of drifted back up, because I think this knee-jerk reaction is a bit of a overdone play, and all the bond buying has now made bonds appreciate a lot. And so now people who bought just even a couple weeks ago have appreciated a bunch, and they can sell and take some profit off the table, which is going to put some selling pressure on the treasury market. So obviously nothing moves in one direction. There's going to be a little bit of a bumpy ride, but at the consensus, at least from a treasury perspective, definitely is that bumpy ride is headed in one direction, and that's down.
What do you think of Warren Buffett owning the most treasury bills right now?
He owns more treasuries than the Fed, which is really unbelievable. I think that you could look at that as a risk meter, and basically he is going fully risk off. And that's the U.S. Treasury market, particularly the 10-year U.S. Treasury, is also a reflection of kind of a risk meter for the markets. And so when treasuries go down, that's because a lot of people are buying treasuries because they view it as a risk-off asset. They view it as a flight to safety. And so, yeah, those are all everything's kind of pointing towards one thing, and that is not a soft landing, but a hard landing. And people are either kind of cowering, or like Warren Buffett, they're preparing.
So we have that going on, and then we've got some kind of foreign items going on, depending on when this show airs and we listen to it. It could be a different situation there, but it seems like there's also some uncertainty in the Middle East and that region, which also could be contributing some issues as well. And also, you've got an election coming up. So it's kind of a perfect storm of irregularity going on right now. There could be an emergency meeting to cut rates quickly. So there's really a lot of turbulence.
It's actually really interesting about rates, because there's a difference between what the Fed should do and what they're going to do. Because the Fed has to do so much to manage perception, because it's pretty fair to say that the Fed should cut 50 basis points on the September meeting. And it wouldn't be outrageous to also assert that the Fed should cut prior to the September meeting. But if the Fed does cut prior to September, that would signal panic. It's like, oh, we got it wrong. We need to actually intervene and cut sooner than anticipated, sooner than normally scheduled. And that's a bad look. It's going to kind of rattle markets rather than calm them down, which obviously the point of rate cuts is not just to re-stimulate the economy, but it's also to calm down markets. We want to ease financial conditions, because right now financial conditions are rapidly tightening because of the way that people feel, right? It's a psychology business. So it's interesting that the market is now pricing in somewhere between a 50 basis point cut in September, and even there is a decent probability of a cut prior to the September meeting, but you have to weigh also what the Fed thinks they should do, not just what they think is what's best for the economy.
Right. So with that said, how do the properties fare with the ones we have in escrow right now? It's really nice because we've locked in, what theoretical debt would be at a higher number. So our purchase prices are the same, but rates are obviously floating down. And I was kind of learning some interesting information about just the loan application process, which is there is a rate floor, a rate ceiling potentially. So can you kind of break down the nuances of what a commercial loan is? Because so frequently we get asked, hey, you're going to rate lock today. I've gotten probably 24 emails regarding the two deals that we're raising on, regarding, oh, hey, when are you going to rate lock? One deal is 1031 exchange component to it, one deal does not. But maybe for those situations, without getting into specifics of the name, and maybe even the property level, how just the debt market works.
Well, for people that are familiar with residential mortgages, they would be shocked to find out just how complex and unfavorable commercial financing is for commercial real estate. And yeah, residential mortgages are so friendly. You get more LTV, you get no prepayment penalties, and all these things you don't really have to think about. But
It's
in the
actually,
commercial,
yeah,
yeah, it's wildly different. And I get it, right? Because a commercial mortgage is it's a business product, it's a financial product, and a residential mortgage is more of like a consumer good. It's more of a consumer product, right? It's an end consumer who's using it, not necessarily a investment professional or industry professional. So I understand where they're coming from and how this all works, but the point is there's all these fine prints that you need to understand and be prepared to look out for and negotiate when it comes to commercial real estate financing. And so what you're alluding to are interest rate floors. And this only applies to fixed rate loans because of the very simple fact that when you sign up a loan application for a fixed rate loan, you don't actually lock the rate usually at that time. You usually lock the rate just a couple days before closing. So there's a period of time that could range from a month to even 3 months from when you sign up the deal to when you actually lock in the rate. And during that time, obviously, there could be volatility. And volatility can go in your favor or volatility could go against you. And we've experienced both, right? And it's certainly no fun when you think you're going to have, let's say, a 5% rate, and then it goes up and up and up while you're under contract, and you end up closing at a 5.5. That's painful. It does throw off your numbers, which is why you want to bake in some cushion and be conservative. But the other way can happen as well, where you underwrite a 6% rate, as we have done more recently, and then while we've been under contract, treasuries have moved violently downwards, and now we actually look at 5-year treasury being somewhere around potentially 3.5%, which could be a 50 basis point discount to where we thought rates were, which actually moves our numbers materially. The problem is lenders don't want you to win so easily, and so they actually put in treasury floors so that even if treasuries come down while you're under a loan application, you actually can get stopped out by your treasury floor. So if you like sign the application when treasuries were 4%, and then your floor is 3.8%, and then treasuries blow down to 3.5%, you actually don't get any of the savings below 3.8. You get stopped out, and your interest rate is going to be based on a treasury floor of 3.8% plus your lender spread, whatever it is above that.
So while you're through that process and things go on, if it gets better, can you move around the terms of your loan? What's the cost looking like there? Could you kind of use proceeds? Maybe if you get more, debt, could you use more of the equity there to buy stuff down? What does that process look like? More kind of loan modifications, perhaps in a favorable direction, depending on the circumstance.
There's definitely some flexibility, but not a whole ton when it comes to floors. Floors are tricky in that way. That's why it's really important to not ignore your treasury floor as kind of like a throwaway in the fine print of your term sheet, and to actually look at it, especially right now as we're in a falling rate environment, because it can really be, you can miss out on a lot if you aren't able to negotiate that treasury floor. But there's only so much flexibility there. However, if you can actually benefit from rates coming down and you're under loan application for an agency product like Fannie Mae and Freddie Mac, then you could potentially see your DSCR improve enough to where, not saying this is that common, but if you were previously sizing to a 125 DSCR, and then now because rates are so much lower, you might be able to squeeze up in size to a 1.35 DSCR, right? You might be interested in switching to a different loan product and getting more interest only, for example, because now your DSCR is higher, or that might allow you to qualify for it's different waivers. So that's something to look into, but also just simply getting more proceeds. If you were previously debt service coverage ratio constrained and not LTV constrained, well, for every basis point that your rate goes down, your DSCR improves, which actually should make your loan amount improve. So if you are looking for more leverage, a falling rate environment can help.
Very cool. Well, I'm happy we hit that because it's a interesting subject that people who have deals locked up for are working through right now if they are agency debt takers and leveragers, if you will. So as we go through this process coming up, just because treasuries even fall further down doesn't mean we can necessarily get that much better of a rate on particular deals we've locked up right now. But for the future, we'll likely have a better floor and frankly, just better overall debt. And then the next kind of topic with that said is how long does it take for the market to react to this, right? Because, commercial real estate deals are really slow trading, from LOI to getting the deal in control to PSA to closing. That can take 6 months. I mean, it's taken us sometimes, 12 months before, 11 months before to close, a bigger deal, not on our end from constraint, but just from moving parts. So we'd be interested to hear, how the market reacts when debt, is affected, for the better or worse.
Yeah, I think people like to oversimplify, and I'm certainly a fan of simplicity as well, but rate movements don't impact real estate valuations one to one. They might in a spreadsheet, but they don't in reality. And when I say in a spreadsheet, it's very simple. If you pull out your Excel underwriting model and you have a 6% rate, and then you take that 6% rate and you knock it down to 5%, we all know that that's going to make the numbers look way better in the spreadsheet. And therefore, logically, you could say, well, I can now afford to pay more for this deal if I'm solving for the same returns if I just move the interest rate down. Right. And so from that perspective, it's basically a one-to-one relationship of interest rates coming down. Therefore, your price is able to go up, which cap rates are an inverse relationship between price. So that would imply interest rates go down, cap rate goes down, that you're willing to pay for the property or what the property is valued at. The problem is if you look at the data and if you also understand the reality at just even high level, there's only about a 70% correlation between rates and cap rates. And that 30%, there's a whole lot going on in that 30%. There's psychology, there's capital flows, there's asset rotation, which is capital flows really. But like just as an example, after COVID, everyone was rotating out of retail and hospitality, and they were rotating into multifamily and industrial. So what happens when all those real estate investors move out of those two asset classes and pile into industrial and multi? That's going to push down cap rates, irrespective of what rates are doing. So rates could have been going up, but that rotation would still be a downward pressure on cap rates. So that 30% is very meaningful and is the nuance that is always at play. And what I would argue is during times of volatility and uncertainty, that 30% non-correlation of cap rates to interest rates expands out to perhaps even 50%, because right now is a perfect example. Right now, rates are coming down. So you would go, oh, that's great for real estate, right? Real estate should be worth more today. Well, not so fast, because what's going on with investor psychology? Look at the stock market. Look at people getting capital called. Look at foreclosures. Look at what's happening in the broader economy as far as the labor market, as far as consumer spending, as far as consumer sentiment, right? There's a lot of negatives that would make an investor go, maybe I don't want to pay more for that multifamily property, right? Even though rates are lower. So I think, and that's not necessarily a bad thing, right? Because we could be heading into what could be perhaps even the most exciting part of the cycle, where we see a divergence of cap rates and interest rates, where we find the biggest spreads, where the sentiment is the most negative. And that speaks to your original question about a lag effect, which is exactly correct, because we could see rates come down, and then there's a lag effect as people still say negative about the market. That creates a big spread between cap rates and interest rates, which is the best time to buy. And then eventually people are going to kind of become sanguine and then positive, and then cap rates will go down, which will make prices go up, which of course squeezes the margin down. So like we always preach, buy at all points of the cycle, but we've already been in a very interesting time, but now it could be a new interesting time.
All right. Well, it's always an interesting time in the market. It's just the levels and the levers that change it as we're in a new environment now than we were before. And that said, I want to talk about capital, segueing from that subject. And there's multiple ways you can, put together and structure the debt equity of the deal, which you know all too well about as you wrote a book on the subject. But there are various forms. Really what I want to talk about right now is JV equity versus syndicated equity. So can you break down the two different groups and what we've been doing more of late, and maybe the future long-term goal that we have at Lone Star?
Yeah, so I feel like this is a big topic that has been talked about in a lot of different ways and in a lot of different circles. And I don't say that to mean, oh, well, it's already been talked about, let's not talk about it. It's an important topic and it's a valuable topic. And so one of the ways to categorize syndication versus joint venture is 100 chicken dinners, one lobster dinner, right? So, or another way people talk about it is you're passing the hat around and raising money from country club money or family and friends versus institutional money,
I
and
wish
going
I could
to one.
clubs and raise money.
You wish you could do what now?
I wish I could go to country clubs and raise money.
I think with the way you've been shooting it lately, I think you just might.
I know I might have to take that up.
Yeah, I think there might be a future there. So
Sorry, I
when you're
apologize for the Terrible interruption.
No, that's all right. That's all right. So with syndications, it's much more of a scrappy way to raise capital because you're going out hat in hand and you're asking individuals and smaller fund managers to either just directly invest or pool smaller funds together to invest into the offering. With a JV, you're talking about one single source of equity to fund 90% or more of the equity required for the deal. And while the dollars at the end are the same, meaning if you're raising $20 million, you got to either get it through syndication or through joint venture, or even a combination of the two, the way you arrive at that $20 million is radically different. And I think what's important about this topic specifically for today is the fact that I think gone are the days of it being optimal to kind of cut your teeth in family and friends capital, and then once you grow out of that, then you go to the JV side, and then you start partnering with the big shops, and you go to New York, and you're getting these 10, 20, $30 million checks. I don't think the path is so linear anymore, or at least the optimal path, because you're seeing it play out in the first half of this year where a lot of people who relied and continue to rely solely on their joint venture relationships have been kind of stuck on the sidelines because those people have their own capital formation issues and their own bugaboos about putting out fresh capital in the market right now. Whereas if you are a sponsor like us who has a diverse range of capital partners that range from joint venture to family office to fund of funds to co-GP to retail individuals, we are still able to raise capital even at the most difficult times to raise money. And like we were talking about on last week's episode, when you're able to do both, which is buy when it's difficult to buy and raise capital when it's difficult to raise capital, those are the best deals, and you get rewarded for that unique ability. So that's kind of a one-sided answer for kind of specifically what's happening right now. But that's exactly why we've been able to buy institutional quality deals with retail syndication capital, right? And that mismatch is what's created the opportunity.
So what's required for a group to be a good fit for JV? Because you've got to be very buttoned up. You're going to get scrutinized a bit more than a typical person who might bring us, $1 million to the fund to fund program or some, bespoke esque boutique, capital allocator fund manager of sorts. So what is needed on that side of the aisle? And then we'll get into the syndication side and why I actually kind of prefer the syndication side now.
Yeah, I love that you say that, and I would love to kind of hear your side of the story. So JV is both our brain damage, right? So there's no, like, people will always think the grass is always
There's
greener,
silver
right?
bullet. Yes.
You bump into someone who has built these amazing joint venture relationships, and they've got partners that they can call up and they can raise $20 million in one phone call, and they'll complain to you about how that partner is so needy, they're so greedy, they can't charge the fees they want to charge, and they control the deal, and you never know what they're going to say or whatnot, or like they might back out of the deal, and then all that money is just out of the deal now, and they go, gosh, I just wish I could be a syndicator and just be able to raise money how I want, do the deals that I want, how I want. And then the syndicator is looking at the joint venture guy and going, gosh, I can't believe I'm on my 100th investor call of the day. Like, why can't I just have a joint venture partner? That would be so much better. So people think the grass is always greener, but it's not. It's brain damage any way you slice it. It's just a different kind of brain damage. So when you're talking about joint venture, the brain damage is all in the due diligence. And also, it's all in the courting phase, because the hump of getting the first deal done with a JV equity partner is really where all the work is done, because it takes so much friction for them to want to go away from their repeat partners who they already have trust, who they've already vetted and gotten through their investment committee. So they're not going to look stupid doing their 27th deal with XYZ sponsor to their bosses and their investment committee. But they might look stupid if they bring a new sponsor to the table and vouch for them and have to just push this new deal, this new sponsor. So there's a lot of
It's
friction.
risky. You can lose a job doing that, right?
Yeah,
Going out on a
that's
limb
right.
can get you fired.
Totally. So people on the JV side are cautious of new. So that's why the new portion of the job is so difficult from a sponsor's perspective. You need to really put your best foot forward. You need to be persistent. You need to show a lot of good deals. You need to show that you're a great sponsor. And the only way to do that is to go through a JV partner's rigorous due diligence process on a sponsor DD level as well as a deal DD level. And even if they don't end up investing in that deal that they do diligence on, which they probably won't, it still leaves a mark and it still leaves an impression as far as what they thought about working with you through that experience. So it's super important to treat every rep like a live rep, even if it's most likely going to be a pass. So that's the brain damage on the JV side of things. And then I think people can kind of understand the quote unquote brain damage associated with more syndication, just because instead of one investor, you're dealing with 100 or 200 or 500, depending on the deal size.
Without a doubt. Well, let's go to, also some of the nuances behind JV equity and why I'm becoming a lot more partial to the syndication route as opposed to the JV route. So one of the issues that I kind of partake with or have with joint venture equity is control rights. So we're acquiring a deal right now from sellers that have joint venture equity with an equity group that has control rights, and they're forcing a sale on the deal. So that's a situation where, if you have the luxury and the leeway with your loan length, it probably wouldn't make sense for you to sell. The only reason why you're selling is if your equity is likely forcing it. So that is what we're seeing right now with a couple of deals. So do you want to touch on, kind of have you thought about that and, other strings attached to the process?
Yeah, it's funny that you say that because a lot of people actually do bring that up as a sticking point for them. But I actually feel like the control rights are the least problematic part of a joint venture partnership because at the end of the day, the way I look at it, and I've said this a million times, is I don't care what the documents say. Whoever has the most money in the deal has control, right? I would never want to go against the wishes of the actual equity because yes, we're in the business of real estate and management and operations and investment, but we're in a customer service business. We're here to deliver satisfaction to our investors. So we're here to serve our investors. And if our investors want control and if they want to sell and we don't disagree with it, sure, we can push back as essentially a fiduciary, but I don't want to go against that. So to me, that's not the biggest issue, but I totally understand where you're coming from and how here is an example where the LP psychology is perhaps getting in the way with the overall success of the investment. And that could be certainly frustrating from a sponsor's perspective if they have high conviction in the deal to be more successful down the line, which of course would provide them a more attractive promote. Or maybe the LP is forcing sale where the sponsor isn't going to get any promote. So you're at odds, right? Because the sponsor, if they're going to sell and not even make any money on the sale, then the sponsor would probably just rather continue to hold the deal and collect property management and asset management fees. But the LP isn't obviously looking at it that way. They're looking at it like, hey, we have other opportunities on the horizon. Let's cut our losses. Or we think this is a fine exit point, even though we're not going to make a lot of money, right? It's not a perfect marriage, but the way that you overcome that imperfection is thinking long-term about the relationship. Because the last thing as a sponsor we would ever want to do is cut our nose off to spite our face and do something short-term, a short-term benefit in exchange for a long-term gain, which relationships are always the long-term gain.
Right. And then syndication, the headache associated with that is, let's say if we're raising money on a deal and someone flops on the raise, meaning they, committed to bring in a certain number of dollars and then end up bringing, half of that or none of that, that puts you with a hole there. But I guess the counterpoint to that is, well, technically a JV group could bring you to the final hour and then walk away from the deal if fundamentals change on you there, which is probably worse because one partner of, let's say, raising 10 million and one's gone, well, it's easy to replace 1 million than it is the whole, obviously, ladder or the majority of the check.
Yes, that's exactly right. When a lot of people who are newer in the business will come to me and ask about their fear of, well, if I partner with a joint venture group and they're providing 90% of the equity, what do I do if they pull out last minute? And that's even more dangerous than if $1 million investor pulls out, right? Imagine $10 million pulling out or whatever it is, whatever 90% of the deal is, right? You're stuck and you're going to have to, and we've had it happen before. I mean, not often, but It does happen, but it's very rare because JV equity is sensitive to this issue and this concern. And if they want repeat business, if they want partners that will bring them good deals consistently and are excited to partner with them, this is what they need to bring to the table. And this is why you need to look beyond the fees and how much money you can make on a given deal, because it's a partnership. It's a two-way street, right? They're banking on you bringing the deal and you're banking on them bringing the money. And if something falls apart, it could be very painful for one or both sides. So you need to do your due diligence on a JV equity partner and talk about, okay, what's your term sheet to close ratio? What does every step of the process mean? Because for different groups, a term sheet can mean different things. Sometimes a term sheet's just like, hey, we're kind of interested in the deal. Let us poke around and do some more due diligence. Whereas other groups, if they issue a term sheet, that term sheet is as good as money in the bank. And you need to know, you need to understand where they're coming from and what they mean when they say, okay, this is where we are in the process. So it's really important to have that communication to ask those questions.
So outside of course, coming to our conference, where have we been able to find a lot of our partners from the syndication world of things, as well as the joint venture world of things?
Yeah, the two biggest places are events, going to the right conferences, meeting the right people, of course. And then the other place that I found success just kind of opening the door and building those relationships is just online. And when I say online, I don't mean going on Facebook and trying to friend someone or going on LinkedIn. I mean, LinkedIn is not so bad, but you need to kind of be in the business and in the know, because there's only a handful of names. And if you're swimming in the right pond and you kind of are in the right circles, you will come across their names. So if you're looking out for press releases, or if you're looking at LinkedIn posts, people talking about, hey, I just closed this deal in partnership with this LP, and hey, this LP is partnering with this sponsor, right? It's kind of like everyone knows each other. Everyone knows that real estate's a really tight knit business, and so it's not like the big name equity shops are hiding in secret, right? Like everyone knows about the big names. Not to say that you should only partner or only seek to partner with the big names, but they're out there.
Right, and that's also why, just too generally, we're going to, as in really more me moving forward to conferences where, in person places where you've got a list and a roster of attendees going has been very crucial. Prior to an event, it's at least 10 to 12 hours of, homework on the front end to make sure that I'm connecting with the right people while I'm on site there, posting on LinkedIn, messaging people on LinkedIn, messaging people on the services there. And that's always been effective because I'm not going to go to a conference and just kind of walk around and try to meet someone willy-nilly. I'm, very much so trying to be as intentional as possible and leveling up our way of doing things, hosting dinners, being very intentional, things of that nature. Uh, so happy we discussed that. We made a recent switch as well for, I believe, maybe all of our partners properties moving forward, which was changing where we're advertising our apartment vacancies and listings. So one big and recent change that we've done is we are no longer going to be partnering, or to the extent at least that we were before, on apartments.com. So I would love to hear kind of the reason for that change, and kind of our experiences without that, which led us to want to, I guess, move on.
Yeah, sure. So this is kind of a niche topic, but it's one of the changes and one of the ways that we're willing to be in some way a trailblazer or just go against the grain in multifamily operations. And that is, we are canceling all of our apartments.com contracts. And this is obviously public and this is recorded, and we could totally go down as being wrong. And we might pivot later and say, you know what, it was wrong of us and we actually need those services back. So we might admit our wrongs in the future. But for today, we've decided that we think we can be successful in marketing our units and staying leased up at optimal rates without using, or being beholden rather, to the monopoly that is apartments.com. So everyone knows apartments.com. It's a monopoly and they charge monopoly pricing. For our properties, it could be at least 20 to over even $30,000 per year just to be able to advertise and participate in the apartments.com ecosystem. And so, yes, apartments.com is a monopoly, and therefore a lot of prospective residents are there. However, that's a big number. That's a big cost. And there are other ways to attract, especially our demographic. We don't lease super high end Class A units. We have workforce housing, and so we have properties that have experience and a proven track record of creating strong leasing demand through much cheaper, if not free, advertising mediums such as Facebook pages, Facebook marketing, and doing some guerrilla marketing 2024 style, not putting flyers on cars, but actually infiltrating certain Facebook groups, housing groups, and stuff like that. And another thing, like I talked about last week on the show, which is going into Facebook groups for local police officers and posting advertisements about our courtesy officer program, where we can provide discounted rent to police officers in exchange for patrol services and things like that, to create a safer community, which attracts higher demand, decreases turnover, more cash flow, and it also is just a good service to be able to provide discounted rent to local police officers.
Without a doubt. So we're going there. What other mediums are we using? And I also like, by the way, for the answer, that we are not forever away from apartments.com. That could change. But with that said, what mediums outside of that are useful other than Facebook groups and local groups and maybe nearing employment centers for listings there?
Yeah, there's other things you could do like Craigslist. So a lot of our properties have been doing Craigslist for a while, but you really don't need to go any further than Facebook Marketplace. You just have to be diligent on posting there every single day, multiple times per day, which refreshes the posts and attracts more and more people.
What is a new, actually high for us, by the way, is that we raised officially $1.1 million from the podcast from a single check writer, retail in-house investor. So that's very exciting. So shout out to him. And that's just really cool that we've been able to accomplish that on this medium, where I don't think he heard of us other than from social media, and then went to our podcast. And next thing you know, he's a big investor.
Can you clarify that 1.1 million isn't the total amount of dollars that we've raised from the podcast?
No, yes.
What is that?
That 1.1 million is a new investor, his first time investing with us, one check and one deal. That is not the cumulative amount of dollars that we have created from this show.
Very impressive. Very impressive.
Yeah, well, that's pretty cool. Any other thoughts on that? Or
well, I think it is interesting because I feel kind of like silly that I'm smoking a cigar and I'm not wearing a suit and I'm outside, and one could think that I'm not taking this seriously, or that we're not very serious about our careers and our business here, but that couldn't be further from the truth, right? And this is something that I never would have thought of doing, because especially when I started the business when I was 21 years old, I was deathly afraid of being perceived as unserious or unreliable or untrustworthy, and someone that people shouldn't invest with, right? And as I've matured and I've realized, and people have told me over and over again, that, hey, you need to be yourself in order for people to want to trust in who you are and get to know you and things like that. People don't just invest in numbers, they invest in people. So I've gotten more comfortable to come out of my shell. And so I guess this is an example of that.
Well, with that said, big cheers to that, and to the next investors that we get from this channel and from doing content like this. If you are looking to get any question you would like answered on the show, email me. It's craig@lscre.com. If you're looking to invest with us, learn about partnerships, or learn about our summit event that is coming up, we're very excited about. We're going to level up the ante from where it was a year before, which was crazy because last year was really special. But with that said, if you have any inquiry, email me. And with that, we'll see you next week.